Hey everybody, Economic Ninja here. I hope you're doing well. I am here with Andy Schectman of Miles Franklin today. We're going to be talking about real estate, the mortgage rate increases that just happened. It seems like they're just smoking upward. And we're going to be talking about gold and silver a little bit and what they do in these times of uncertainty. Andy, how are you doing?
Great to see you again, Travis. I'm good, buddy. How about yourself?
I'm doing good. As a matter of fact, we're going to see each other very soon because you're flying out to Dallas. And actually, Miles Franklin, I wanted everyone to know, actually made a very nice contribution to the event, sponsored it so that we could keep the prices low. So I really appreciate it, Andy.
I'm looking so forward to it. It'd be nice to get back, and get back and doing things in person again. So I'm looking forward to seeing you and all the listeners out there. I've already gotten emails from people. So looking forward to it very much.
Yeah, and it sounds like all the VIP tickets have already sold out. So we've got general admission left, and I'm really excited to see everybody and shake everybody's hands and give some hugs. So, hey, let's talk about the mortgage industry. I don't know if you were following it, but I just briefly told you we're seeing as of today. The average 30-year fixed rates are almost bumping 4.25%. What do you think about that?
I think it's crazy. A year ago you were under 3% on the 30-year. To see an escalation like that is tremendous, especially in the light of real estate and the parabolic rise it's had. And I'll add to that, in listening to what Jerome Powell was talking about the other day in paring down their balance sheet, what he was saying is that he only wants to have U.S. Treasuries on the balance sheet. So you're talking somewhere in the neighborhood of just under $3 trillion worth of mortgage-backed securities that they're going to dump onto the market in a short period of time. You start seeing a rise in rates prior to something like that. Maybe this is the way of the market pricing that kind of rhetoric in. But then a dumping of that kind of quantity of mortgage-backed securities onto the market could really wreak havoc, I think, with the real estate market. I think this is something that's front and center and typical in your fashion, always talking about something before the public does. So I think this is a big one and probably is going to start to be noticed much, much more by the mainstream here pretty soon.
Yeah, I completely agree. And it's funny because we're starting to see the 10-year bond start to move up. Like you said, people are starting to position themselves now because they're going, there's no way the economy can take this when we're talking about all of the money that's been created in the last couple of years, beside what we saw with QE from 2010. But I want to share the screen here and then we're going to get your thoughts. Let me see where we go. Here we go. All right. So we're going to start over here. So today, CNBC, obviously, I'm going to be putting this out a day late, guys, but all the indices are up. Dow Jones up 314, S&P up 64. And it almost seems like everything's great. But when I come over to here, here's the chart for the 30-year mortgage. Yeah. And it's funny because I was an investor in real estate in 2001. And I sold all my homes. I started in mid 2005, got out by 2006. And a lot of people said, wow, you were early. And I said, I wasn't, because the crash actually happened in 06. And the reason why is because rates were heading up from 2004 to 2006. And now we're literally, today's price is actually at 2010 mortgage levels. And what I want to talk about is, because I have people all the time saying, yeah, Ninja, that's only like a percent. Who cares? Like Andy just said, hey, it was at 3% last year. It's only a percent. But on a percentage basis, that is like, what is it? 33, 34% more of your money is going to interest today if you buy a house than last year. So what do you think about that? What's that going to do to the, if this holds up, to the real estate market?
It's been shown, Travis, that a 1% rise in interest rates correlates to a 10% decrease in property values. So, if we think the Fed holds true to their statement of 3 or 4 quarter basis point rate hikes over the next year, and then to double that the following year, let's say we get to 2% on the federal funds rate, and that would correspond historically to a 20% decrease in property values. When you talk about everyone buying, a lot of people buying, in these inflated prices as the last few years have gone on, and all the people leaving the cities and buying up residential over the last year or so, myself included, you could be looking at a 20% decrease in property value just in that alone, putting people in terms of equity underwater. And even more to the point, when you look at what we've seen just on the 10-year Treasury, to your point, about a 40 basis point rise over the last few weeks, I saw that for the last month, new mortgage applications were down 10%, just in a 40 basis point increase. So when you talk about record high price values of real estate coupled with rising cost of money, it doesn't, it's oil and water, they don't mix. So I would suspect that you'll see a corresponding decrease in property values as interest rates continue to rise. It's just more people are priced out of the ability to own homes that a year ago or 2 years ago, with easy money and low interest rates, were a little bit more affordable. Not so much anymore.
Yeah, I completely agree with you. Now, I want to bring up this one story right here, this Fox Business 2 days ago. It's funny, it's 2 days ago. It says mortgage refinance demand spikes 18% as interest rates stabilize. Now, obviously, that's in hindsight. They're talking about something that happened either a few days prior to that story coming out, or maybe even a few weeks. But last night, I got up, it was like midnight, and I noticed that the 30-year, it hit average around 4% with no points, just a standard loan. And then this morning I wake up and that had changed to 4.25. Now it's fun as we read headlines, people are always trying to calm markets down, especially like when we had Ben Bernanke so famously coming out in 2006 and saying, don't worry, we have stemmed the tide. The mortgage industry is safe and fine. But we're seeing a lot of cracks. Even the ECB, I don't know if you've heard, has been calling on the Fed to not go so aggressive. Yet I've seen some of their governors calling for 75 basis points, a hike, of essentially 0.75%, because they're trying to stamp inflation out too. But it's ironic, both banks are making their interest rate hikes possible in March. What do you think that we may see in March if indeed both banks do decide to raise rates?
Well, again, I think it's spitting in the ocean. When you talk about raising rates, yes, it starts to have an effect. I mean, when all of this debt was calculated or accumulated rather at the lowest interest rates in history, it does start to have an effect. But when you look at what Paul Volcker did in 1980, he rose the federal funds rate above the rate of inflation, all the way up to 20%. When you look at a 7% CPI print, well, we've already talked ad nauseum on all the interviews you and I do, and you do a whole lot more than me. I'm sure you've mentioned John Williams and Shadow Stats a few times.
Oh, yeah.
Which he's talking about a 15%, nearly a 15% inflation, but just take the CPI at 7. They would have to raise the federal funds rate by 700 basis points to even make a dent at inflation. So, we talk about a 2% rise and raising interest rates are not good for gold and this and that, but it's all a bunch of nonsense, because a 2% raise is still 5% negative in terms of real terms. So my point is, what I think they're trying to do, Travis, they're trying to give themselves wiggle room. The world reserve currency cannot go real negative. They want to go nominally negative. We're already going nominally negative. They don't want to go real negative. And so they are going to raise rates. We will see them start in March. And maybe it'll be more aggressive than a quarter. Maybe it'll be a half point. It'll rattle the markets, certainly. But in terms of its real effect, it's really, they can't. And this is where things start to get interesting. If they really do sell the 2.7 trillion in mortgage-backed securities starting in March, if they really do start to raise rates starting in March, if they really follow through with the getting tough on inflation rhetoric that we're seeing, then we should all buckle up and brace for impact. I don't think they will.
Well, so that's a great point.
We'll
I look at them with a magazine that they want to load into a firearm, and every time they raise those rates, it's one bullet in the cartridge so that they can fire those bullets if they need it during a downturn in the economy and start to lower rates. Now, what's really interesting is gold did great from the year 2000, mid 2015, early 2016 to 2018, because that's when the last time the Fed started raising rates from a quarter point to 25 basis points up to, they barely got to 2.25 percentage point interest rate until everything started to collapse. And so they barely got there. And that was with a lot less debt than we have today. So the question is, I think that we're going to see a lot of markets rattled. I think this is a great time to be in cash and metals. But I still am trying to tell people the difference between paper metals and what happens, like, let's say the ETFs or, SLV, GLD, what happens to those? Because they do get smashed during a market shakeup. However, the VIG just explodes to the upside. on the actual physical because it's so hard to get a hold of. Now, aren't you guys seeing some issues right now to get a hold of physical?
You know, I've been saying that for a long time. And so, the more I say it, the more I have to almost try to inadvertently defend my position, because people think that I'm just trying to, you know, rush people into the door to buy metal before the sky falls. And I get that. I mean, it's easy to be a cynic in this world nowadays after what we see around us everywhere. It's nonstop bombarding of less than genuine rhetoric. I try to be as honest as I possibly can, Travis, and I'll tell you, in the 32 years I've owned this company, it's never been more difficult. It's getting hard. You know, you see our good buddy Jeffrey Christian talk about the shortness of all of the commodities from copper to oil to, you know, it's starting to happen in physical precious metals too. Honestly, it is beginning to happen across the board. So it's tough.
Hey, Jeffrey, if you're watching, I can't wait to have that next beer with you. Just, you know, but no, honestly, you know, let's talk about that. I'm gonna defend Andy right now. I've been an investor of physical gold and silver since 2010. We have seen a couple of times where supply gets tight and the VIG runs up, the price over spot runs up. And we've seen it last sometimes as long as 3 to maybe 6 months. I honestly think that for the you know, the next year or so, I think the tide has turned. I think that we are going to see elevated prices over spot for quite some time, because the need or the desire for metals is totally different than times past. Along with the invention of Wall Street silver, and the first time ever, I think probably in my career, and definitely Andy's, or even Andy's, we've never seen this many people actually form together and start to share information about economics, right, Andy?
Yeah, that's a huge point. And with it, you have the younger generation. I can't believe I'm saying the younger generation, but you have the younger generation who's understood the merits of owning cryptocurrencies. And even if the reason a lot of people own crypto is to get wealthy, I think the underlying theme is that it is the antithesis to the crypto, or to the fiat currency system. There is an awareness, and I think there will be an awakening. And whatever trigger it is, whether it be the Fed losing control of the bond market when the world realizes that they're painted into a corner and they have no options, and the bond market starts to throw up and run, whether it be some sort of an event, I don't know what the trigger point is. I think looking back at 2020, no one would have guessed what the trigger point would have been to all of the craziness that we've seen. But my point is, there will come a realization that precious metals are a place to be when things start to unravel. And a lot of us already realize that, but the public doesn't yet. And but there is a broader awareness, a greater understanding. In fact, if you look, I think just about every poll out there right now will tell you that inflation is a greater concern than COVID is right now. It's starting to seep into the psyche of the public. They're aware of what's going on. And I think when you look at, like, you know, you mentioned the pre-08 or the 08 great financial crisis, you know, the Levy Economic Institute just released something the other day where the Fed had sealed the records from 08 for 12 years, and they challenged them. The Levy did all the way to unseal these in the Freedom of Information Act, all the way to the Supreme Court. When they finally released it, you know, we were told back then, in terms of where we are with this inflation, it was 700 billion creating TARP, which created the Tea Party, 700 billion going to infrastructure, and 3 trillion to the banks. We were told it was roughly $5 trillion, but in these newly released forms, we see it was now $29 trillion, and money sprinkled all across the globe, including into China, into Germany and into England and into Japan. Coincidentally, you have inflation in Germany and in the UK, the highest it's been since World War II. So we've exported our inflation all across the globe. Yeah. And so I think when the world realizes that there are no options left, and it's the governments are choosing the printing press over the tough decisions, that's when getting precious metals will become much, much harder, because, you know, it represents a very small percentage of the assets in this country. And I think when the realization becomes stark, I think getting the product will be the biggest challenge, more so than an elevated price.
Yeah. I'd like to close on this last question. And I know you and I are pretty close in age, so I don't know if you remember it very well, because I definitely don't. So I was too young, but perhaps your dad has shared stories of this. In 1980, obviously the 70s saw inflation, but they saw a blow off top, and people didn't actually wake up to gold and silver as an answer, even though it was trending up until the very end, right? The masses run at the very end, just like at the Great Depression. Okay. The crash happened a couple years prior, but then they rushed to the banks the day of. What was it like? Because the world didn't see that much inflation as much as the US was going through back in 1980 when Paul Volcker spiked those rates. What were the stories? Did your dad ever share stories of what it was like in his business? Because wasn't he doing gold and silver back then?
So I'll tell you two stories that he did share with me. I was 10 years old in 1980, so I don't remember them, but there are two stories he's told me. One was in terms of during the oil embargo and high inflation in 1980, there were gas stations in Minneapolis that were accepting silver dimes, the pre-65 dimes for a gallon of gas. Now, at $50 silver or thereabouts, that would equate to over a $3 melt value in a silver dime. So it was a good deal for both parties, I guess you could say. But the more interesting story, my dad started in the industry in 1983 at Investment Rarities. And at the time, Investment Rarities was located right out by the Minneapolis-St. Paul airport. And they were on the same circuit, I guess you'd say, on phone jargon, as Northwest Airlines, which became Delta, or Delta bought them out rather. And so there was such craziness in the metals market that it actually blew out the circuits for Northwest Airlines as the phones were ringing off the hook nonstop. So, I think that the old saying that 90% of 90% of the gain is in the last 10% of the move. Absolutely. Something along those lines is emblematic of what you can expect. The herd always comes in late, and that's why people owe you a debt of gratitude who've been listening to you for a long time before it was fashionable to tell them, hey, wake up, get in the game, start to slowly add to your portfolio, divest of dollars, et cetera, whatever the message is. You've been telling them for a long time, but the public, unfortunately, they'll come in after we see the move, after it becomes obvious, after it's becoming not as economical to make that move. So yeah, I think that's what I take away from what he had told me back then. And then after that, it crashed because Paul Volcker came in and raised rates so high that's the only way to stop the gold bull market. That's the only way to stop inflation, is to raise rates above the level of inflation. And if anyone thinks they're going to raise rates over 700 basis points over the next 2 years, then yeah, maybe the gold bull will turn to a bear. In the meantime, I think, unfortunately, to a large degree, gold has a long room yet to run.
I'm going to say not unfortunately, because we're going to go crush it and buy everybody's stuff. So I'm on the other side. Well, hey guys, in closing, I want to thank Andy for this. I want to thank Andy for coming out and sponsoring the Dallas event. I'm going to put the link below. Also, guys, if you're interested in buying some silver, there's a deal right now. I've got a link below for 1 ounce silver Buffalo rounds, $3.19 per ounce over spot. And to give you an idea, I just did some research. You got to buy 1,500 ounces to beat that price in some of these places. So that's pretty sweet. I'm going to have that link below. Thanks again, Andy. I really appreciate you coming on.
It's my pleasure to be here. It's my honor to be part of your show and what you're doing. I mean that wholeheartedly. I look very forward to that handshake, maybe even a hug and one of those beers, and we'll save a seat for Jeffrey as well.
Big hug, 2 beers, and Jeffrey, you're invited. All right. With that being said, guys, the Economic Ninja is out.